Welcome to the Real News Network. I'm Paul Jay. We're in Bretton Woods, New Hampshire. We're at the INET conference talking about causes and solutions for the economic crisis. And one of the factors many people have pointed to as a contributing factor to the crisis is various forms of executive compensation that lead executives to be more concerned about their own quick bucks than what's good for the economy, or certainly for their, even sometimes for their own company. Now joining us to talk about one form this takes is William Lazonick. He's a professor of economics at the University of Massachusetts. Thanks for joining us.
Oh yeah, nice to be here.
So you've been doing some work on this whole question of the way companies do stock buybacks and the effect that has and why it takes place. So explain to us what this is about.
Okay, so the thing people see most readily is this constant increase in executive pay that gets into the papers, and we'll talk about sometimes an explosion of executive pay. That goes back already to the early 90s, where people were saying, you know, why is pay now 100 times what a worker gets, the average worker gets? It was 40 times in 1980. It turns out that 40 times is pretty high too by international comparison, particularly when you look at the Japanese who you're competing against then. Okay, but the pay just kept going up. And now it's, in 2000, it was up as high as 500 times, and now it's maybe anywhere between 300 and 400 times. Okay, and when you start looking at the components of executive pay, you see that anywhere from 50 to 80% of the pay, let's say of the top 500, comes from the actual gains they make when they exercise stock options. So stock options are these the right to buy a stock at a certain price that are given to them by the board, and they then at some point, they usually have a window of 9 or 10 years, can say, okay, the stock price has gone up. I want to exercise the price. They exercise the stock, they sell it, they make some money.
And so in theory, at least on the face of it, it sounds like compensation is somehow linked to performance.
Yeah, so if you take the stock price as being a measure of performance, which has become the norm since the 1980s and is very much related to this increased executive pay, you could say, okay, that's what the good performance of a company, and so that is why they're getting paid. Okay, the problem is when you start looking at what actually drives stock prices. I divide into 3 different types of things. I say a company can actually produce higher quality, lower cost products, that it has a competitive advantage in the market, it gains market share, and this is what I call generally innovation, and then the stock price goes up. Usually that's after the fact. People then say, hey, I should have invested in Cisco 5 years ago, Microsoft or Google or whatever. Okay, so that is something that actually is better performance. But that's not been, I would argue, over the last 15 years or so, even the last 20 years, the main driver of the stock market. So the other 2 things are speculation, which most people recognize. There's also these speculative bubbles. And the third thing is manipulation. And speculation was something that really was occurring, became stronger and stronger through the 80s and 90s, and then until the internet boom crashed. You have, if you look at the stock price yields, so the average yields of stock prices in the 80s and 90s. In the 80s are about 12% per year. In the 90s are about 15% a year. So you can't lose. You know, I mean, there might be ups and downs, but particularly since you have this long window, you just figure out when to do it. Okay.
Meaning you can't lose if you
have
stock
options. And I should say it's not just top executives, because really one of the things they did in companies like Cisco or Intel or Microsoft, Google, everybody has stock options. Although what the people at the top get is sometimes 1,000 more what everybody else gets. But nevertheless, this. Okay.
Well, so far in the argument. It's linked somehow to something real in the world.
So you have the innovation, then actually the speculation often results from innovation. So they say, I should have bought Microsoft 5 years ago, and then you start speculating it, and people then at some point there's just people who know that, hoping there's some greater fool out there that's going to buy the stock, and there's some. The stock market investors, as we know, anybody's looked at what's happened recently.
Let's get to manipulation.
Yeah.
So this is the category that gets
So basically what we get is in 2000, this boom, this peak, and then it comes down. Okay, now rather than say, well, those are just crazy valuations, okay, now we're back to normal, basically the corporate world said, how can we get stock prices up again? Now, something they had started doing already in the 80s, but not that systematically, was buying back their stock. Okay, now, this was something that they really didn't do very much before the mid-1980s. For one thing, SEC regulations could say this is manipulation if you do a large-scale buyback.
Kind of is.
It is.
I mean, obviously, you buy a bunch of your stock, the price is going to go up, and you triggered it.
Yeah,
and
so,
you had foreknowledge of it.
Yeah, and so what happened in November of 1982? It's one of these under-the-radar SEC changes in the rules. Who knows who's pushing for them? They say companies can do large-scale buybacks and not get charged with manipulation. It's a safe harbor. It's still in place. That then became useful for companies if they wanted to get their stock price boosted. So when the crash of 1987 is actually well known that IBM came in and started doing some big buybacks and started getting the market moving up. Other companies came in. And so this actually was a way of you have a crash, get the market up. Okay, if it just happened, in those extreme circumstances, you might say that's not a bad idea. After 9/11, when the stock market was closed for 4 days, about 120 companies came in to buy back their stocks, and they said it for patriotic reasons because you wanted to make sure the market. And again, you say, okay, in extreme circumstances, maybe you want to just stay, it's a stabilization. But what had happened is it became systematic. Okay, so, and actually stock buybacks as a form.
And just to remind everybody, again, the people making the decisions are sitting on stock options.
They benefit.
That if they can get the price up, they exercise the option.
It's even worse than that, because we know when a company is going to announces a program to buy stock. So let's say that Microsoft has a $40 billion program over the next 4 years, which is more or less what it has. The board will have to approve it. It will be announced. That's what we know about. We don't actually know when they're buying back the stock. And it's thought that companies use this, for example, to offset bad news, to hit quarterly earnings targets, to get earnings per share up there. Now, this started being used much more systematically in the 90s by companies that weren't getting that speculative hit from the market and wanted to keep up. So companies like Cisco, that the market was speculating on it, they didn't need to buy back their stock. Although in the next decade, huge repurchaser of stock, but then they didn't need to. Okay, so but it started then, and by 1997, buybacks as a form of distribution to shareholders had surpassed dividends. Now, dividends are very different from buybacks. The dividends say you hold the stock, you get an income. Buybacks say you have to sell the stock.
If you want to take advantage of the up, you have to sell.
And this means that dividends are based on stability, buybacks on volatility.
Other shareholders don't mind because they've driven the share up. They can cash out and find some, I shouldn't use the word sucker, but somebody who will buy in after they've just hit the peak.
So let's say a big institution.
And so they don't care how much compensation the CEO or whoever's making.
Well, they don't,
because they just made them a whack of money.
If they can get the stock price up.
So who loses? It's a win-win.
So here, who loses? Okay, well, let me just say that in the 2000s, this doesn't just become something, or the aughts as we call them, didn't just become a thing that some companies did once in a while. It became basically something that companies did all the time. And in 2003, for the S&P 500, the 500 companies in the index, it was about $300 million per company in 2003, which is already a high number. It was $1.2 billion in 2007. So that was about $600 billion just before the economy tanked. That was spent just boosting the stock price back up. They actually got the S&P 500 index in 2007 slightly higher than it had been in 2000. But whereas in 2000 it had come up there up through speculation, now it was coming up through what I call manipulation. Okay, now why does it matter? Meanwhile, you have a kind of history that goes back to the early 1980s when we got hit by Japanese competition of good jobs being lost in the U.S. economy. So you have a whole separate discussion about the loss of middle-class jobs. Okay, and that now we see that it's not just blue-collar workers, because most of them have disappeared. It's also a lot of white-collar workers, university-educated people in their 40s and 50s with lots of experience who the economy should be able to make use of, who are not getting employment or getting laid off and can't find jobs to use their education and experience. Okay, those companies are, at the same time they're doing the buybacks, they're getting rid of people.
So they're downsizing.
Yeah.
They're not investing in innovation.
Yeah.
But they're using their money to buy, up the stock price because these guys can make money on it.
Yeah, the other thing that's going on here is that there's globalization, so in fact often they're making a lot of money overseas, in China particularly, but they're not reinvesting it back in the United States. Now there's no reason why they shouldn't necessarily reinvest it back in the United States, but that's not what they want to do with it. They want to buy back their stock. I should say that in 2008, 2009, buybacks went way down, particularly in 2009, because companies didn't have the profits to do it, but now they're on the way up. And so I predict another escalation of this.
So a lot of people talking about how you have to have lower and lower corporate taxes. Yeah. If the savings on the tax is just being used for stock buybacks, there's no,
that's one way.
Benefit here.
That's one way of looking at it. Other people say we need more. I'm not against government stimulus or government spending at all, but if people say what we need is government stimulus to get this economy going, the theory behind that is there's lack of business confidence. No, there isn't any lack of business confidence. Any kind of break the business gets, they're going to use that money to buy back stock. And let's take a sector that like the health insurers. Okay, so we have a debate going on in this country because it's not just about jobs. Cost of health insurance. So I would say most people would probably say we got these health insurers, but we're getting low quality, high cost services from them. Okay, that's not the opposite of innovation. The major health insurers, United Health Group, Aetna, WellPoint, they spend 100%, over 100% of their profits buying back their stock. So anytime they exclude someone because of a precondition, makes them more money, that's what they're doing with the money. It goes from sector to sector. In oil refining, we have ExxonMobil, 164 billion bought back in stock in the last decade. We need investment in alternative energy.
So what would you do about it?
Okay, so first of all, I would ban stock buybacks. I say a large company to buy back its stock is a manipulation of the market. That's already something that's recognized in SEC regulation as this potentially being a manipulation, except they gave them the safe harbor. Okay, it's also stock buybacks.
They being the Bush-Cheney administration.
No, well, this goes back to 1982. So this was under
82. I'm sorry, I thought it was 2002.
No, 82. No, this,
it was the Reagan administration.
Yeah, this was right at the start of the long stock market boom. And in fact, John Shadd, who was the commissioner of the SEC at the time, said in one report that was done on this, let's do this so it would boost the stock market. Okay, it also says some countries stock buybacks are illegal. In Europe, most countries made them legal in the late 90s to try to get into the acquisition game because they wanted to get their stocks up and let their companies acquire.
Okay, so you would,
but I would ban those.
Regulate them, ban them completely.
I would ban them, but because I don't, they have no, they're a manipulation of the market by these large companies. The second thing is stock options. Okay, if you want to pay people in stock, there's lots of different ways to pay them. So let's say you use stock options where you don't actually have to buy the stock. There's no risk until you buy it. I'd say that you can't make money off them as a top executive, or probably as anybody, unless you do better than your competitors, better than the market as a whole. So you don't. So you try to have rules about.
So it's not just based on share value, it's based on overall performance.
So there's some index. Now, Britain has this. So Britain has, in the 90s, they put together a code of corporate governance, which has these sets of rules. They're not obligatory, but many companies use them to ensure that if their executives get paid from gains from exercising stock options, they've done better than their competitors, or they've done better than the FTSE 100.
So it's not just a manipulation.
And it's not speculation. So you try to eliminate the speculation from it so that it really reflects better performance, and you don't allow the manipulation. So that there's two sides of it. Speculation you can never get rid of. I mean, you can't have a stock market without speculation, but you can get rid of it in the way you reward the executive so that they don't benefit from something where the market's just rising because of speculation. Everybody's going to benefit. You just eliminate that.
Very good. Thank you.
Okay.
Thank you for joining us on the Real News Network.